It wasn't the pandemic stimulus packages of 2020. It wasn't the supply chain fractures of the following year. It wasn't even the kinetic escalation of geopolitical conflict in Eastern Europe or the Middle East. It was the structural breaking point of a debt supercycle that has been building since 1971. The event that just occurred is technical. It is obscure. It is buried in the footnotes of balance sheets that almost no one reads, but the implications are total. For the first time in history, the institutions designed to guarantee the value of money have become the primary source of its instability. The guardians of the currency have quietly become its executioners. The arithmetic is merciless. The pattern is unmistakable. We are witnessing the transition from the management of a currency to the management of its decline. This is not a political opinion. It is not a conspiracy theory. It is a mechanical reality driven by compound interest and sovereign insolvency. The central banks have crossed a line from which there is no return. They have begun to monetize debt, not to stimulate the economy, but to prevent the immediate default of the sovereign state. This is the final signal. It has happened before. It happened in the 3rd century. It happened in the 16th century. It happened in the 20th century. Every time this specific threshold is crossed, the outcome is identical. The incentive structure allows for no other path. When the choice is between the immediate collapse of the government and the slow destruction of the currency, the state always chooses the currency. Always. The risk is not that they will fail to act. The risk is that they will succeed in doing exactly what history dictates they must do. Under these constraints, the rational move for the state is to inflate away the debt. The rational move for the individual is to exit the blast radius of that inflation. To understand why this time is not different, we must look at the 3 specific moments in history where this exact mechanism played out. The first clear instance of this terminal pattern appears in the later stages of the Roman Empire, specifically during the crisis of the 3rd century. For nearly 200 years, the Roman monetary system was the bedrock of Western commerce. The silver denarius was the standard .1. It was trusted from the chaotic markets of Alexandria to the frozen outposts of Britannia. A soldier knew what his pay was worth. A merchant knew what his grain would fetch. But the costs of maintaining a sprawling, overextended empire began to outpace the productivity of the economy. The state faced a dilemma. To pay the legions required to secure the borders, the emperors needed more silver than the mines could produce. Raising taxes was politically dangerous and administratively difficult in a pre-digital age. So they chose the invisible tax. They chose the shortcut. Starting under Emperor Nero and accelerating violently under the Severan dynasty, the state began to debase the currency. 2. They did not announce this policy. They simply recalled the silver coins, melted them down, mixed in base metals like copper and bronze, and reminted them with the same face value but less precious metal content. By the time of Emperor Gallienus in the 260s AD, the silver content of the denarius had collapsed from 95% to less than 5%. The coins were no longer silver. They were copper discs with a thin, deceptive wash of silver that rubbed off after a few weeks of circulation. The result was not immediate collapse, but a slow, grinding destruction of the social contract. Merchants, realizing they were being paid in worthless slugs, demanded more coins for the same goods. This was not greed. It was survival. The price of wheat in Egypt, the empire's breadbasket, skyrocketed from 8 drachmas per artaba to over 120,000 drachmas in less than a century. The state's response was not to fix the money, but to attack the merchants. In 301 AD, Emperor Diocletian issued the Edict on Maximum Prices. 3. It was a massive bureaucratic attempt to suspend the laws of supply and demand by imperial decree. The edict listed over 1,000 goods and services, setting strict price caps for everything from bushels of barley to the wages of a camel driver. The penalty for violating the edict was death. The result was catastrophic. Goods vanished from the markets entirely. Farmers refused to bring their produce to the cities because the mandated price was lower than the cost of production. A thriving trade economy collapsed into a primitive barter system. The middle class, the shopkeepers, the artisans, the small landowners was wiped out. They could not hedge against the inflation, nor could they evade the price controls. The only people who survived were the ultra-wealthy, who moved their capital into massive, self-sustaining country estates, and the military elite who were paid in gold solidi, the only coin the state refused to debase. The empire did not fall because of barbarians at the gates. It fell because the internal economic engine had been destroyed by monetary fraud. Just like the Roman debasement, the Spanish Empire in the 16th and 17th centuries fell victim to the illusion that more money equals more wealth. This example is critical because it shows how even the richest power on earth can destroy itself through monetary ignorance. Following the discovery of the Americas, Spain gained control of the richest silver mines the world had ever seen, specifically the mountain of Potosi in modern-day Bolivia. From 1545 onward, a river of silver flowed across the Atlantic, into the port of Seville, and straight into the coffers of the Spanish crown. On paper, Spain was invincible. They had the best infantry in Europe and an endless supply of money. But the crown, specifically under Philip II, misunderstood the nature of money. They used the silver not to invest in domestic industry or productivity, but to finance endless wars and import luxury goods. They treated the silver as income, but they spent it like water. Because the domestic economy of Spain was not producing enough goods to match the influx of silver, prices began to soar. This phenomenon is now known to historians as the price revolution. The cost of living in Spain quintupled. A Castilian wool merchant, once the backbone of the economy, found that his goods were too expensive to export, while cheap foreign goods flooded in, paid for by Spanish silver. In the markets of Madrid, there were two prices for every item, the silver price and the vellon price. This velocity of money accelerated the inflation. It was not merely that Germany lost the First World War. It was the decision to print the difference between tax revenue and the reparations demanded by the Allies. The public realized that the supply of money was infinite, but the supply of goods was shrinking. Industrialists who owned factories and machines saw their debts evaporate while their assets retained value. The social fabric was torn apart, creating the vacuum that would eventually be filled by extremism. The Weimar hyperinflation proves that when a central bank prioritizes the funding of the state over the stability of the currency dies. Budgets are balanced, and debt is minimal. Public works and military reach expand. Politicians, unwilling to cut spending, begin to borrow. Stage 5 is inflation and suppression. The currency is abandoned. A new system is established, usually wiping out the savings of the previous generation. This reset is often accompanied by political upheaval or a change in the form of government. Just like the trajectory of Rome, Spain, and Weimar, current data suggest we are deep into Stage 5 and transitioning toward Stage 6. The unprecedented action referenced earlier is the behavior of the major central banks since the banking stress of early 2023. For the first time, central banks are operating with significant negative equity on a mark-to-market basis. Because they aggressively raised interest rates to fight the inflation they created, the value of the trillions of dollars of government bonds they hold on their own balance sheets has collapsed. In a normal corporate environment, they would be insolvent. But they have changed the accounting rules to ignore these losses. More critically, they have signaled that they will provide unlimited liquidity to the banking system to prevent the realization of these losses. This creates a paradoxical situation where they are trying to tighten monetary policy to fight inflation, while simultaneously loosening it to save the banks and the sovereign bond market. They are pressing the brake and the accelerator at the same time. The hidden systemic risk they are trying to contain is the sovereign debt spiral. Interest payments on government debt have risen to levels that rival defense budgets. 10 If interest rates remain high, the government becomes insolvent. If interest rates are cut, inflation returns with a vengeance. The central banks are trapped. One interpretation is that they have chosen the path of financial repression. This means keeping interest rates below the rate of inflation for a decade or more to burn off the real value of the debt. This is exactly what was done after World War II. But the difference today is that debt levels are far higher and demographics are far worse. There is a counter-argument to this grim assessment. Many economists argue that modern central banks have tools that Rome and Weimar did not. They argue that because the debts are denominated in their own currency, they can never technically default. They point to the strength of the dollar and the lack of a viable alternative, global reserve currency, as proof that the system is stable. They suggest that managed inflation is a viable policy tool to smooth out the debt burden without causing a collapse. This argument relies on the assumption that the rest of the world will continue to accept depreciating paper in exchange for real goods and resources indefinitely. But the incentives suggest otherwise. As the purchasing power of the currency declines, foreign holders of the debt have less reason to hold it. We are already seeing central banks in the East accumulating gold at the fastest pace in decades. They are voting with their balance sheets. Furthermore, the arithmetic of the interest payments is inescapable. When the interest on the debt consumes all tax revenue, the government must print money just to keep the lights on. That is the definition of the Weimar loop. The tools may be digital, but the mechanics of solvency are unchanged. The endgame approaches in one of three ways. The first is controlled decline. This is the preferred path of the state. It involves decades of high inflation, negative real interest rates, and increased taxes. Living standards slowly erode. The middle class is ground down, but the system remains intact. This is similar to the British Empire's decline from 1914 to the 1970s, a long, slow slide where the pound lost 90% of its purchasing power, but society did not collapse into anarchy. The second possibility is chaotic collapse. This occurs if the public loses confidence suddenly. If a bond auction fails, or if a major bank failure triggers a panic that the central bank cannot print its way out of, the currency could enter a hyperinflationary spiral. This is the Weimar or Zimbabwe scenario. It is fast, violent, and leads to total political restructuring. The third possibility is a reset and restructure. This is the Bretton Woods scenario. Governments gather to rewrite the rules of the global monetary system. They may peg currencies to a basket of commodities, introduce a new digital standard, or revalue gold to a price that covers the outstanding liabilities. This happened in 1944 and again in 1971. In this scenario, debt is often written off or restructured, and the currency is redefined. The only variable is timing and pain. The trajectory is set by the math of the debt. The outcome is set by the incentives of the state. What remains uncertain is how long the illusion can be maintained, and who will be left holding the bag when it breaks. Those who understand the pattern can prepare. They can educate themselves on the difference between currency and money. They can build resilience in their skills and their communities. They can pay attention to the data, not the headlines. Subscribe to follow the signal through the noise.